Hey traders, John Hell here. Hope you're doing well. In this video, I'm going to talk about market makers running stops and also running options as well too. So let's get straight into it. Do not place a trade based on what you see in this video. Trading can cause substantial financial loss. There is no guarantees of making a profit in the markets, and this video is just to educate you and not to give you financial advice. Grab your free trading course right now, 100% free 12-hour X Factor trading course. You're going to learn things like top 13 deadly mistakes, 10K per month plan, amazing charting boundaries techniques, #1 chart reading technique, powerful reversal techniques, ultimate trading system, blast off trading system, #1 trading indicator, millionaire trader mindset, so much more. 12-hour trading course. Click the link in the description right now to get free membership access right now. Okay, traders. So I'm going to talk to you guys about. I'm going to answer a question here that was actually on one of my videos I did recently. I did a video here recently called "How I Trade Options." And when you actually scroll down here, I had a question here. And honest Rivera, he said, "Thanks, John. I started using options, so he's trading options. Unfortunately, the market maker triggered my stop at the open." Or at the open of the market without the stock reaching that level. And this is actually, I want to talk about this. Okay, firstly here, unfortunately the market maker trigger at my stop at the market without the stock reaching that level. One thing you need to understand about options, I'll talk more about as I go through this video, but one, you said here, my stop, market makers triggered my stop at the open without the stock reaching that level. Now the thing is this, is that the options do fluctuate based on the actual price as well too, but they also fluctuate a lot depending on whether people are selling that off. So there's more people selling that option, therefore obviously the option is going to get cheaper and cheaper and cheaper. Or if a lot of people are buying that option up, the market's going to go up and up and up. So yeah, sometimes what can happen is you might be in a call option, i.e. you want the market to go up, and sometimes the market can actually pull back a little bit. You know, it might pull back 1 or 2% on you on the option, on the stock, and sometimes that may be enough. And it's not the market maker that's actually running you. I'll talk about that in a minute, but sometimes it is the market maker. If you are trading an option that has very low open interest and low volume, then yeah, you're running the risk of that of you being triggered with a stop because it's only the market maker in there. Therefore, you want to have an open interest of like 150 plus. You know what I mean? And you want to have a lot of volume going in there, not just 1 or 2 contracts. You want, you know, at least 50 or 100 contracts going through there, 150 on the open interest. You know what I mean? Like that shows you there's a lot of other people in there. Therefore, it's not the market maker that's actually running that option. It's a lot of people buying and selling that. What can happen is that if you get into an option, and yes, you may be in a call option. This happens so many times on my trades. I'll get into a call option, and during the first half of the day or the first half hour, the market might pull back against that trade a little bit, 1 or 2 or 3%. And what can happen is the people who actually have bought that option the day before, a couple of days before, they may freak out and they may start to sell at the market, sell at market. And therefore, instead of the option dropping down maybe 10 or 20%, now it's going down to 30, 35% and more because they're dropping it. And then what happens? And then, as you said here, that level after a day of nice gain, they even pay me a higher price, etc., etc. What can also happen is what will generally happen as well too, especially if you've got a good trading system. And you know your trading system again. Firstly, you've got to have a good trading system. If you don't have a good trading system, then that's where you need to start, okay? But a trading system means you have a good trading pattern. So if you have a good trading pattern, therefore, you know, if you're trading stocks where there's not much volume in there and not much open interest on that option, therefore stay away from those things. Because yeah, even sometimes I'll get in there and I'll have a much bigger loss and bad entries and so on and so forth. Makes sense? So stay away from those things. But if you do have your stop in there at that price, what can happen, as I said before, when the market opens, they sell it down, they get you. Then what happens? The market regains that during the day, and then before you know it, the market continues up. Have a nice little profit, nice little update by the close, and therefore you got triggered on your 30% stop out or 20% stop out, and now the option's worth 30%. And the other day, that happened to me so many times when I was trading options, so many times, because the market can fluctuate. And as I said before, is that yes, the options it's a derivative of the actual stock price. But what does happen sometimes is that those option prices can fluctuate a lot more depending on people. If you have You know, like if a lot of the top stocks have thousands of contracts going through there, you know, and thousands of open interest and hundreds of contracts going through. So if people start to get very fearful of that stock going down a lot more, they will start to sell. Therefore, the stock price didn't really move much. And also happens on the other side. You know, like I've been in a stock where the market only went up 2%, but my option went up like 60% because everyone started to buy that option up because everyone's starting to go, oh my goodness, this thing's going off. I need to get in. Bam, bam, bam. And they bought it up. Obviously, the opposite can happen on the other side. So it's not the market maker that triggered you. If the market maker did trigger you, the only way the market maker can trigger you is if you are only trading low options or low open interest stocks and low volume stocks. If you are looking at an option price and there's like maybe 10 open interest and 1 or 2 contracts here and stuff like that, forget who cares about the spread. The spread I don't really care about. My thing is that does it have a lot of open interest, you know? And is the open interest pretty consistent? You know, is there a lot of open interest throughout all the contracts that are being there? It's not like just, oh, here's one or two options that have really good open interest and really good volume. Even those stocks I'll stay away from. Sometimes I'll get into that. And even if the market does go for me, you know, I remember one stock, I got into it and I did that exact same thing. The market ran for me 5%, but I only got out like a 25% profit. It was crazy. So you want to stay away from those sort of things. So once again, if the market maker did trigger, you're trading a stock that has very low open interest, low volume. Stay away from those stocks and those if you're going to trade options. The second thing I must say is that if you're going to stay away from those things, the second thing I must say is, and this has come from your fear base, is I realized early on to not actually have any exit orders at all when I buy the option. Now, most people freak out because of fear, right? And their fear says to them, "Oh my goodness, if I do that, I'm going to lose 100% on this option." Now, depending on what option you buy, you may lose 100%, and you've got to understand that risk. If you're trading second or third out of the money with an option, and the market goes against you 2 or 3%, yeah, that option could lose 50 to 70% overnight. You've got to understand that, depending on what option you're buying. If you're buying an out-of-the-money option and you put an exit order in for 20%, yeah, that thing's going to get triggered every single time. You're going against the grain. You know what I mean? Because that's going to be a lot more volatile option. So when I trade out-of-the-money options, I always trade first out of the money only. That seems to be the best for me. And I understand that I'm looking, you know, a big stop out will actually be around about 50% for me. That'll be a big stop out for me. So therefore, I know that consciously going into the markets, and I know majority of the time the market's going to run in my favor because I believe in my system. So therefore, I don't put any exit orders in because of exactly what I said there about the market, about those options fluctuating. I just know by the time I get out of that trade, majority of the time I get out of that trade, the options are going to be worth a lot more, etc., etc., etc. Makes sense? And it comes down to the belief of that system. Now, the thing is that depending on what option you're buying and your risk tolerance. Now, if you put exit orders in, you're doing that because you're not happy with the risk that's in the markets. You may be putting too much of your account into the market itself, or you may be trading 20% or 30% in the markets. If you're trading 20% of your account and you're trading second or third out of the money because they're cheaper options, which is a big mistake, by the way, then yes, I can understand the reason why you'd be nervous, because yes, overnight, if you're trading like second or third out of the money and the market goes against you, say 4% in a day, yeah, you will lose pretty much 90% of that option overnight because it's so far out and there's no intrinsic value. But if you're looking at, say, the INTC here as an example, last price is 43.24. Basically, at the money is 43. The first in the money is 42, and the second in the money would be, say, 41. If you look to buy and say the $41 option here, it's got a lot of the intrinsic value there. So therefore that gives you that buffer to say if the market does go against me, I can still get out with I can still get out with 70% of my income, or 70% of my position that I put in there. Now, that's not all the time, but one of the best things that I've done in my option trading career is not have any exit orders in there. And the only reason why people do that is because they're fearful. They're really fearful of doing that. And I realize more times than not, because I know my trading system's going to run in my favor more times than not, therefore I make money more times than not. Does that make sense, guys? And so, honest, if you're watching this video right now, I hope that makes sense to you right now. I hope this gives you a lot of things in there. If you there's a lot of things that actually goes into options trading and what you're doing there. And you know, are you trading out of the money? Are you trading too much? Yeah, and there's a lot of things that goes on there. If you and the thing is as I said before, that when you're trading in the money options, you've got that intrinsic value. That intrinsic value gives you that buffer. So therefore, like you've got to think about, okay, then if I trade 5% of my account on this option, a massive loss would be 50 or so percent in that option. Like that, especially if you're trading like second in the money, which is like a 41. There, because it's got a lot of buffer there. Now, again, guys, it all comes down to your belief in your trading system. It all comes down to, do you know that at least 7 times out of 10, this thing's going to run on, this thing's going to go in the direction of that market or of that trade that you're in. If you know that, therefore you shouldn't be worried about the options, because therefore majority of the time, and the way the options work that I have found is that the 7 times that it does run on for you, you're going to on average make more money if you just let it go on those winning trades than you will on average, not every single trade, but on average your losses. So you're going to have 7 wins, and especially if you're trading, once again, if you're trading in the money options, if you do that, this is my experience, okay? And this is just trading my trading system. When I trade first or second in the money, my average loss is 20 to 30%. My average profit is 50 to 60%, sometimes 80% when I have a really good move for me. When I'm trading out of the money options, that's what I do right now. I trade first out of the money, but I know my losses my average loss can be 50%. But the thing is, like that's also a big loss as well too. You know what I mean? Like that's also like, okay, the market didn't go for me. Say 30 to 50% is my loss when I'm trading out of money, because there's no intrinsic value there. But because majority of the time, 7, 8 times out of 10, the market runs for me in my favor, what will happen is I know that my options will go to, you know, 100%, 200%. Like for example, last week I had say 4 trades. Okay, say 3 trades. And so last week I had 3 trades. I had 1 stop at 50%. So I had a 50% loss. I must accept that if I'm trading 5% of my account, how much am I really risking in my mind without putting eggs in it? I'm risking roughly 2.5% of my account. Did you see how that works? Now that's not all the time, but that's roughly. But guess what I had there? I had a 2.5% loss, but then guess what? I had another trade there that made 55%. So basically my account was at break even then, a 1 loss, 1 profit. And then my next trade gave me a 200% profit just in one day. That was the MFIN. That was this trade right here. Makes sense? So that was here. You can see them. I got in here, and I got in here, and then the market ran up, and then I got in here as well. Does that make sense? And so what you want to look at is what you want to look at is like this one here. Again, bam! I trade out of the money. It was $5, and from here to here, it ran up. Once again, and I traded. Oh, let me just do this here. Right, so I got into here, and let me just share, like this is the option price that I got into here. This is just an example of what I'm saying to you about how this all works. So you got candlesticks here, and this is the option price, right? So I bought the $5 option first out of the money, right? And the option here, as you can see, was worth 25 cents. As soon as I got out, you can see, well, actually, I got in a much cheaper price on this one here. I think it was like 20 cents that I got in here. So 20 cents, and then as you can see, and then the option was worth, I think this one here says it was around that there. You see here I got in at 20 cents and I sold at something there, but the option price was at 200% when I actually sold it, depending on where this is at. Make sense? So what I'm trying to share with you here is this one here within one day ran up 200%. So I know that can happen. 100% profit and a 200% profit is not that uncommon when I'm trading out of the money options, especially when the market moves for me the very next day pretty quickly. You know, I'll give you another example here. Like when you're talking about INTC, this INTC, I did the exact same thing here as well too. Let me go back here. So what did I do here? This one here was in this one right here. All right, so this one right here, this was the entry signal let me just go back to here for a minute. Let me scroll back here for a minute. All right. So right here was my entry signal. Okay. What did I do? I bought the $45 option. Let me go to the $45 calls here and you'll be able to see. So now I bought the $45 call option in I think it was actually December I bought those, not the February ones. January. So January 18. So yeah, so I bought the $45 ones, the $45 in January there, from there to there. So there you go. So this was the January ones because I bought it back in here. So as you can see, this January one was worth down here was around about, it was from there, it was around about 80 cents, and the very next day it went up. The very next day, the option was worth well over 100%, but I got about 95% profit out of that one. So what I'm trying to share with you guys here is that you need to know what your average, what are you risking there. So I know, as I said before, a big loss for me in the option price is going to be, say, 50%. But as I said before, because I know majority of my trades will run on for profit, therefore I know, now not every trade, sometimes I'm going to get a 25% or a 30% profit or a 40% profit. That's going to be the way the trading works. But I know that a good percentage of my trades, is going to run on and move for me in a big way. Does that make sense? So you've got to understand your risk, and therefore I don't actually put any stops in the market at all because I accept the risk. I also accept the fact that yes, I could lose 100% overnight. Makes sense? I do know, but I know that that's highly unlikely, and it's never happened to me ever. Why? Because if you're trading, say, even first out of the money, and you're trading with plenty of time in that option, plenty of time. Now this option here has got 4 days left. It's January, but that back here it actually had plenty of time in that option. So therefore, what happens is you are moving forward and you are trading the markets, and I accept. So if I'm trading 5% of my account, I accept that I could lose all this. I could lose all this 5% of my account. But I accept that risk up front. But I also do know mentally that that's never, ever happened to me if I'm being smart about, having more than 30 days in that option. No, I'm only going to be in it for a couple of days, getting out fast when the market's not moving for me, and stuff like that. And also, I do know if I'm trading first or second in the money, therefore it's going to be a lot less riskier as well too. You know what I mean? Does that make sense, guys? So I hope this really helps you out. I hope it gives you some guidance on the way to trade options and what really happens with trading options, what really happens moving forward there, to really help you and to really guide you into that direction, help you moving forward in a big way there in options. My recommendation is to trade a small percent of your account, but don't have any exit orders in there. But only do that once you know you have a good trading system and you're willing to be disciplined to trade that same trading system again and again. Do not be doing this if you're just buying it because you think it's a good idea. No, that's not going to give you any consistency in the markets. So I hope this helps you out. I hope this gives you a bit more understanding about running stops and market makers and so much more. Make sure you grab the free trading course. Also, make sure you check out my brand new book, The Flow of Success. Tap into the 19 powerful universal laws to succeed in every area in your life faster and easier than ever imagined. Make sure you check out the Facebook page. And also, if you need my help personally and urgently, you can book a 1-hour coaching call with me to help you to get on the track with your trading or anything in life that you need. So all the links are in the description. So go check out that right now.